Hi guys! Enjoy John's analysis.
Okay, before we get into today's topic, I need to tell you something important. Something happened to this channel recently that completely changed the way I think about what we're building here. At first, I honestly saw it as a huge setback, but after thinking about it, I realized it might end up being the best thing that ever happened to this channel. Let me explain. Today, this channel lost its YouTube ad monetization. I won't pretend that didn't hit hard. For a moment, it felt like the ground shifted under something I've spent months building. But here's what I decided in that moment. I decided we don't stop. Not now, not after everything this channel has already become to the people who show up here every week. Because the truth is, this channel was never really about chasing views or riding the news cycle. It was about something bigger than that. It was about helping real people think clearly, hold with conviction, and understand Bitcoin deeply enough to never be shaken by noise. Education does that. Conviction does that. Understanding does that. So today marks the beginning of a completely different chapter for this channel. From now on, my goal isn't only to produce more Bitcoin news. My goal is to create the best educational Bitcoin channel on YouTube for long-term holders. And today's video is the first step in that direction. Here's the part I want to be honest with you about. Without ad revenue, this channel needs a new way to keep existing, and that way is you. Not through donations, not through charity, through something that actually gives you value back. The Bitcoin Holders Bible was built for exactly the kind of thinking this channel is committing to today. By the end of this video, you will know 5 mistakes that quietly drain money from people who never had a real system to hold by. Most people pay for those mistakes one at a time, for years, without ever realizing where the losses were coming from. That is the real cost of not having a system, and it is almost always higher than the cost of building one. The Bitcoin Holders Bible is that system in one place. It normally sells for $97, but because you are here, watching this channel begin its next chapter with me, I want to make this as easy as possible to say yes to. Use the code DIAMOND50 at checkout, and the entire book comes down to $47. And here is my promise to you. If you go through this book and you do not walk away with a clearer system for holding Bitcoin than you had before, one that actually gives you real conviction instead of guesswork, I will refund every dollar. No questions asked. This only works if it actually helps you, so the entire risk is on me, not you. $47 one time for a system most people never build in years of holding and end up paying for anyway through the same 5 mistakes we're breaking down today. The link is pinned in the comments below, and it's also in the description if that's easier for you. Every person who owns it is helping this channel keep making videos like this one. If today's lesson is useful to you, that book goes far deeper than any single video ever could, and this code will not stay available forever. Now, let's get into today's topic. Bitcoin holders do not lose money because they picked the wrong asset. 5 specific mental mistakes are responsible for almost every dollar lost by people who were technically right about Bitcoin's future. This video breaks down all 5 mistakes, one at a time, in the order they usually strike a real portfolio. You will see the academic research behind each mistake, the on-chain data proving it is happening in this exact market right now, and the historical pattern that shows the same 5 mistakes have been repeating since Bitcoin's very first crash. None of this is abstract psychology dressed up as content. Every single mistake on this list has a dollar figure attached to it, and by the end, you will know exactly which one is currently costing you the most. Here's the state of the market as this video is being recorded. Bitcoin fell from a cycle high near $126,000 down toward the $60,000 range, a drawdown of roughly 50% from the peak. That kind of decline sounds catastrophic by the standards of almost any other asset class, and by Bitcoin's own historical standard, it is a fairly ordinary correction. Glassnode's on-chain research shows more than 95% of the short-term holder cohort sitting at an unrealized loss during the worst stretch of this move. The percentage of short-term holder supply held in profit collapsed to roughly 3%, compared with a 4-year average near 55%. That is not a minor dip in sentiment. That is a structural wipeout of an entire cohort of recent buyers. Total realized losses across the network spiked above $1 billion a day at the low, with long-term holders responsible for a large share of that daily figure. Long-term holder realized losses climbed toward $200 million per day during the deepest part of the correction, according to Glassnode's tracking. When holders who have carried a position for more than 6 months start selling at a loss in that volume, it tells you the pain has moved well past the newest, most fragile buyers. There is also a genuine divergence worth noting underneath the surface. Large holder wallets, the addresses commonly tracked as whales, continued accumulating through parts of this drawdown, even while retail sentiment sat in extreme fear. That divergence does not resolve the debate about direction on its own, but it does tell you that the loudest emotional reaction in the room is rarely the same as the most informed one. It is worth pausing on why a single narrator sitting behind a screen even bothers walking through this much on-chain detail before getting to the psychology. The numbers are not decoration. They are the only available evidence for whether a given emotional reaction is proportionate to what is actually happening on the network, or whether it is proportionate only to how loud that emotion feels in the moment. Every mistake in the rest of this video gets easier to catch once you have a habit of checking the data first and the feeling second. This is exactly the emotional environment where all 5 mistakes on this list do the most damage. A market that is down roughly 50% from its peak, with retail underwater and sentiment scraping the bottom of every fear gauge available, is precisely the setup that has preceded both further pain and major recoveries throughout Bitcoin's history. The mistake is not having an opinion about which one happens next. The mistake is letting the wrong psychological trigger make that decision for you. It is worth being precise about why this particular combination of numbers matters more than any single headline. A drawdown alone tells you price moved lower. A drawdown combined with a collapse in short-term holder profitability tells you an entire generation of buyers is trapped underwater at the same time. That combination is what actually produces the emotional intensity behind the 5 mistakes in this video, far more than the percentage decline on its own ever could. None of this guarantees the bottom is in. Long-term holder capitulation, according to Glassnode's own research, had not yet cooled to the levels historically associated with a durable floor. And institutional demand through spot Bitcoin ETFs continued to show net outflows during parts of this stretch. The 5 mistakes in this video are not theoretical. They are being made by real holders in real time inside this exact drawdown, and the data proves it rather than assumes it. The first mistake is buying because everyone else is buying, not because the thesis holds up on its own. This is herding, and it is one of the oldest documented behaviors in financial markets, going back long before Bitcoin existed. In crypto specifically, it shows up as a wave of buying pressure that has almost nothing to do with valuation and almost everything to do with watching other people make money in real time. Academic research on cryptocurrency investors, using a structured method for prioritizing multiple behavioral biases against each other, found that herding and regret aversion were the 2 most influential factors driving investment decisions. Loss aversion and the availability of information ranked lower in that same study. That ordering matters because it means the fear of missing a rally consistently beats the fear of losing money outright for most investors making real decisions in this market. The same body of research shows herding intensifies in both directions, rising during rallies and rising again during crashes. That symmetry is the actual trap hiding inside this mistake. A holder who bought Bitcoin near $126,000 because the crowd was euphoric is running the exact same decision process as a holder who panic sold near $60,000 because the crowd was terrified, even though those 2 decisions feel like opposites. Herding is powered by 2 smaller mechanisms working together. The first is social proof, where seeing other people profit convinces a holder that the crowd must know something they do not. The second is regret aversion, the specific fear of missing a gain and having to live with the memory of not acting, which research has shown outweighs the fear of an equivalent loss for most retail investors. Social media accelerates this mistake far beyond what it looked like in previous market cycles. A rally that used to take weeks to attract crowd attention now attracts it in hours, amplified by trending posts and constant price alerts. By the time a herding-driven buyer feels the pull to act, the easiest, safest part of the move is usually already behind them, and what remains is the riskiest stretch of the rally. This pattern has shown up in nearly every parabolic stretch of Bitcoin's history, and it shows up just as reliably inside individual altcoin rallies during the same cycle. A coin that has already moved several 100% in a matter of weeks becomes more attractive to a herding buyer, not less, because the recent gain is treated as proof rather than as a warning sign. That is backwards from how a rational buyer should treat a parabolic move, and it is precisely why the buyers who show up last tend to absorb the most damage when the move reverses. There's a quieter version of this same mistake that rarely gets discussed, herding into a narrative rather than into a price. A holder can avoid chasing a green candle directly while still buying purely because a specific storyline, repeated often enough across enough channels, started to feel like consensus rather than opinion. That version is harder to notice precisely because it does not feel like FOMO from the inside. It feels like independent research, even when the underlying trigger is still the crowd. Herding does not stop being dangerous just because a bull market feels justified by real fundamentals. Even a legitimate long-term thesis, built on real adoption numbers or real institutional accumulation, can be executed at the worst possible entry price if the buying decision itself was driven by crowd behavior instead of a plan. Being right about the long-term direction of an asset does not protect a holder from being badly wrong about the timing and size of a single entry. The mechanism that pulls a holder in at the top is the same mechanism that can pull that same holder out at the bottom just months later. A holder who cannot explain their entry without referencing what other people were doing at the time has no real basis for holding through the drawdown that almost always follows a herding-driven top. That is the actual cost of this mistake. Not just a bad entry price, but the total absence of a plan to fall back on once the crowd's mood flips. The second mistake is the mirror image of the first. Selling because the pain of watching a position bleed becomes unbearable, not because anything about the original thesis changed. This is loss aversion, and it is one of the most heavily documented biases in all of behavioral finance. It was formally identified by psychologist Daniel Kahneman, whose research on decision-making under uncertainty helped earn him a Nobel Prize. Kahneman demonstrated the underlying mechanism with a simple experiment that has since been replicated across different cultures and income levels. Participants were offered a coin flip. Heads, they gain a certain amount of money. Tails, they lose a smaller amount. Even when the potential gain was meaningfully larger than the potential loss, most people refused the bet unless the payout was roughly twice the size of the downside. That asymmetry means the pain of losing a given amount of money registers, on average, as roughly twice as intense as the pleasure of gaining that same amount. Applied to a coin flip with small final stakes, that reaction is not particularly costly. Applied unconsciously to a multi-year Bitcoin position, it means every red week gets weighted far more heavily in a holder's mind than every green week that came before it, even when the green weeks objectively outnumber the red ones over the life of the position. During the current drawdown, Glassnode tracked the percentage of short-term holder supply sitting in profit falling to roughly 3%, compared with a 4-year average near 55%. That means at the low, more than 95% of the most recent buyer cohort was underwater at the exact same time. Long-term holder realized losses climbed toward $200 million per day, confirming that even holders who had carried a position for more than 6 months were capitulating under the pressure of the drawdown. A separate metric called the short-term holder, spent output profit ratio, which tracks whether coins moving on-chain are being sold at a profit or a loss, dropped deep into capitulation territory during the same window. Readings in that range have historically sat close to the threshold associated with the most severe capitulation events in Bitcoin's history. That is not a small or isolated group of weak hand selling. That is a structural feature of how this specific correction unfolded across an enormous share of the network. A second bias compounds loss aversion at exactly this stage of a drawdown. Recency bias. Whatever the price has been doing for the last few weeks starts to feel to the brain like the permanent new normal, and it becomes psychologically difficult to imagine the trend reversing precisely because the recent trend is the most vivid, most emotionally available information a holder has. During every prior extended Bitcoin drawdown, without exception, the dominant narrative in the weeks surrounding the lowest prices was that the decline would continue indefinitely, right up until it stopped. It helps to name the physical experience underneath this mistake, because it rarely announces itself as a decision at all. Checking the price every few minutes, feeling a tightness that was not there a week earlier, and rehearsing the sell order in your head before you have consciously decided to place it are all signs that loss aversion has already started driving, even while the plan still technically says hold, recognizing that physical signature early is often the only warning a holder gets before the actual sell button gets pressed. None of this means every long-term holder who sells during a drawdown is wrong to do so. Some corrections do turn into genuinely longer declines, and holding through every drawdown without question is not discipline, it is denial dressed up as conviction. A holder who never revisits a thesis, no matter how the underlying data changes, is just as exposed to a real structural failure as a panic seller is exposed to selling a temporary bottom. The mistake is not selling. The mistake is selling purely because the pain crossed an emotional threshold with no reference to any plan made in advance. A holder who sells because a specific predefined condition was met is managing risk. A holder who sells because they could no longer stand to look at the numbers being managed by the market instead of the other way around. If you are watching this while your own position is underwater and you are not sure whether what you are feeling is discipline or panic, that is exactly the gap the Bitcoin Holder's Bible was built to close. It walks you through the specific on-chain thresholds covered in this video, including short-term holder supply and profit, long-term holder realized loss, and the SOPR capitulation zone, translated into a 5-minute weekly protocol. Instead of guessing whether this drawdown looks like the 5 previous ones that recovered or the rare one that did not, you check the same numbers analysts use on a schedule before emotion has a chance to make the decision for you. The regular price is $97, but the code DIAMOND50 at checkout brings it down to $47, and the link is in the description and pinned in the comments. I see the diamond. Let's get back to mistake number 3. The third mistake is selling winning positions too early while holding losing positions far too long. This is called the disposition effect, and it was first rigorously documented in traditional equity markets long before Bitcoin existed as an asset class. The effect describes a consistent, measurable tendency for investors to lock in small gains quickly while letting losing positions run, which is close to the exact opposite of what a rational risk management process would recommend. The foundational research behind this bias examined 10,000 individual trading accounts, calculating the proportion of gains realized against the proportion of losses realized across those accounts. That research confirmed investors were significantly more likely to sell a position sitting at a profit than a position sitting at a loss, holding the losing position instead in the hope it would eventually recover. That same methodology has since become the standard framework researchers use to test for the disposition effect in any new asset class, including cryptocurrency. A 2023 study published in the journal Digital Finance applied that exact methodology directly to Bitcoin traders. The result confirmed the disposition effect is alive and well in this market, and the bias intensified specifically during periods of heavy media coverage and a large inflow of new investors. In other words, the more attention Bitcoin receives in the news, the worse this specific mistake tends to get across the market as a whole. The psychological root of this mistake is prospect theory, developed by Kahneman together with economist Amos Tversky. Their research showed that people evaluate outcomes relative to a reference point, rather than in absolute terms, and they are more sensitive to avoiding a realized loss than to securing an equivalent realized gain. Selling a losing position makes the loss official and permanent in the holder's mind, while continuing to hold it allows the holder to keep believing the loss is temporary, even when the data no longer supports that belief. This plays out in a very specific, recognizable pattern inside a typical Bitcoin portfolio. A holder who bought several different coins over time will often sell the one position that has moved into a modest profit first, purely to feel like the overall decision was validated. Meanwhile, the position sitting at the largest unrealized loss, often the one that most urgently needs to be reassessed, gets left alone precisely because looking at it closely and making a decision would force the holder to confront the loss directly. The financial consequence of this pattern is that a portfolio ends up structurally weighted toward its worst performing positions over time, while its best performing positions get trimmed away early. That is the mathematical opposite of the advice given by nearly every serious long-term investing framework, which generally argues for letting winners run and cutting losses according to a plan. The disposition effect does not just cost a holder money on any single trade. It slowly reshapes an entire portfolio into its least efficient possible configuration. There's a simple test that exposes this mistake in real time, and it takes less time to run than the decision itself usually does. Ask whether you would buy the exact same position today, at today's price, with no prior history attached to it at all. If the honest answer is no for the losing position and yes for the winning one, the disposition effect, not the underlying thesis, is the thing actually making the decision. Holding a losing position is not automatically wrong, and selling a winner is not automatically a mistake either. Context matters more than any blanket rule, and there are legitimate reasons to let a loss run if the original thesis is still fully intact and supported by current data. The disposition effect only becomes a mistake when the decision to hold is driven purely by the discomfort of realizing the loss, rather than by any actual reassessment of the position. A holder who never questions a losing position out of pure disposition bias can end up anchored to a coin that genuinely deserved to be sold long ago, dressed up in the holder's own mind as conviction. That kind of false conviction is more dangerous than an honest loss because it prevents the capital tied up in a dying position from ever being redeployed into something that still has a working thesis behind it. The fourth mistake is anchoring decisions to a single remembered number, usually either the all-time high or the original purchase price. Anchoring is one of the most well-studied biases in all of cognitive psychology, and it describes the brain's tendency to lean heavily on the first or most memorable piece of information it receives, even when that information has stopped being relevant. In Bitcoin specifically, the anchor is almost always a price, and it is almost always a price the market has long since moved away from. Kahneman's research on reference points shows people do not judge financial outcomes against a fixed, objective baseline. They judge them against whatever price is most recently or vividly stuck in memory, and that reference point can shift over time, even when the underlying facts about the asset have not changed at all. When Bitcoin sits near a prior peak, that peak becomes the mental anchor, and every price below it registers as a loss relative to that anchor, sometimes for years afterward. Interestingly, the anchor itself is not even stable. After weeks of watching the price sit near a lower range, a chunk of a holder's brain quietly resets the reference point closer to that recent range instead of the old high. Every small move down from that new lower anchor then gets processed as a fresh loss layered directly on top of the exhaustion from the larger original drawdown, even though nothing about the underlying asset actually changed between those two moments. A published study on the psychological finance behind one of Bitcoin's sharp declines examined a specific crash triggered by a wave of reported thefts, which set off a large number of margin calls in a very short window. The study concluded that the theft itself, while real, was not the primary driver of the scale of the crash. Instead, traders' excessive reliance on anchor points, combined with loss aversion, amplified the reaction well beyond what the actual news event on its own would have justified. This mistake is particularly damaging for a holder who considers themselves a long-term investor, because the entire point of a long-term thesis is supposed to be indifference to short-term price levels. Anchoring quietly undermines that indifference by turning a single historical price point into an emotional reference that colors every subsequent decision. A holder anchored to an old high will often describe the current price using words like cheap or expensive relative to that anchor, rather than relative to any actual valuation framework. Anchoring also shows up in a subtler form around round numbers that were never actually reached, purely because they were widely discussed as targets during the rally. A holder can find themselves treating an unreached round number almost the same way they treat a real historical high, using it as a reference point for disappointment, even though the market never actually traded there. The anchor does not need to be real to distort a decision. It only needs to have been repeated often enough to feel real. The other common version of this mistake is anchoring to the original purchase price rather than the all-time high. A holder who bought at a specific price will frequently refuse to sell below that number even when every other piece of evidence argues for reassessing the position, purely because selling below the purchase price feels like an admission of failure. That number, the exact price paid, has no bearing whatsoever on what the asset is actually worth going forward, yet it frequently dictates the entire decision. The clearest sign that an anchor is running the decision rather than the data is the specific language a holder reaches for under pressure. Phrases built entirely around distance from a remembered number, rather than around any current valuation framework, are the tell every single time. A holder who catches themselves using that kind of language has usually just caught the anchor in the act, which is the first and most useful step toward correcting for it. Letting go of an anchor does not mean ignoring real risk or pretending that price levels carry no information at all. Some declines genuinely do represent the market correctly repricing new information about the asset, and refusing to update a thesis just to avoid the discomfort of being wrong about the original entry is its own separate, equally costly mistake. The discipline here is checking whether the anchor or the actual current data is driving the next decision, and being honest about which one it really is. A holder who cannot articulate a reason for holding or selling that does not reference either the all-time high or their own purchase price has likely found the actual, uncomfortable answer already. This anchoring mistake is not new to this cycle, and it is worth seeing the full historical pattern in specific detail rather than as a vague reassurance. Bitcoin has been through 5 separate drawdowns of 70% or worse across its history. In every one of those 5 cases, holders anchored to the most recent peak treated the distance from that peak as proof the asset was permanently broken. The first came in 2011 when Bitcoin collapsed roughly 94% after a compromised exchange account allowed an attacker to manipulate the reported price in a matter of minutes. It was a tiny market by today's standards, but at the time it was effectively the only market, and the incident badly shook confidence in whether Bitcoin could be safely traded at all. Serious voices in the small community around the asset debated openly whether the project could survive, and within roughly 2 years, price had recovered well beyond its pre-crash level. The second came between 2013 and 2015, a decline of roughly 87% driven by 3 separate shocks landing close together: a restriction on financial institutions handling Bitcoin in China, the collapse of a major exchange after a large sum of customer coins went missing, and a law enforcement shutdown of a marketplace that had tied the asset firmly to criminal activity in mainstream coverage. Respected financial commentators at the time treated the reputational damage as effectively permanent. Within roughly 3 years, price had climbed into the thousands of dollars, a level that would have sounded absurd to most observers during the depths of that decline. The third came in 2018, an 84% decline as the speculative bubble around initial coin offerings collapsed under a wave of regulatory enforcement action. Institutional adoption was widely described at the time by analysts with strong track records in traditional markets as a fantasy that would never materialize. Within roughly 3 years, price had reached new all-time highs, and the institutional adoption, dismissed as fantasy, became the foundation for the regulated investment products that exist today. The fourth came in March of 2020, when Bitcoin fell more than 50% in under 48 hours as the onset of a global pandemic forced a simultaneous liquidation across every asset class on Earth. The immediate narrative was that Bitcoin had failed its first real test as a safe haven asset. Within roughly 20 months, price had climbed from that low to a new all-time high. The fifth came in 2022, a decline of roughly 78%, with the final and sharpest leg down triggered by the collapse of one of the largest exchanges in the industry, later revealed to be one of the largest cases of financial fraud in the sector's history. For a period, Serious institutional voices argued there was no path back for the industry's credibility. Within roughly 3 years, price had reached the cycle high this current drawdown is being measured against. Look at the common thread across all 5. Every single one involved a real, well-documented, legitimately serious event, and nobody was making these catalysts up. The mistake, in hindsight, was never failing to notice the danger. It was treating a genuine but temporary shock as proof of permanent structural failure at precisely the moment fear made that conclusion feel obvious. What is striking about all 5 drawdowns is not just that recoveries eventually followed, but how similar the emotional vocabulary sounded each time, decades apart, and across completely different underlying causes. A security breach, a currency ban, a bubble in speculative fundraising, a global pandemic, and a fraud case at a major exchange have almost nothing in common as events. Yet the anchored reaction each one produced, treating the recent peak as proof of permanent failure, was functionally identical every single time. History rhyming is not history repeating on command, and none of these 5 prior recoveries guarantee anything about how this specific drawdown resolves. Recovery in every past cycle depended on demand actually returning to the market, not on the mere passage of time, and there is no rule requiring demand to return on the same schedule this time or at all. Treat the historical pattern as a reason to question blind panic, not as a reason to assume any specific outcome for the current cycle. The 5th mistake is the most common one nobody notices in themselves, claiming a long-term time horizon out loud while the brain actually processes short-term pain as if it were the entire investment. This gap between the stated plan and the actual decision-making process is subtle, because most holders genuinely believe their own long-term framing in the moment they say it out loud. The gap only becomes visible when you look at what the same holder actually does 3 weeks into a drawdown. A 2023 neuroscience study published in Frontiers in Neuroscience examined exactly this gap in Bitcoin holders and described the mechanism as temporal discounting. Temporal discounting is the tendency to weigh a near-term outcome, whether a gain or loss, far more heavily than a more distant outcome, even when the distant outcome is objectively larger or more important to the overall goal. Applied to Bitcoin, that means near-term losses get weighted far more heavily in a holder's actual decisions than the stated multi-year plan would ever justify on paper. In plain terms, the holder's mouth says years, but the holder's decisions say weeks. A holder who tells themselves and everyone else that they are investing on a 5 or 10-year horizon will often make an irreversible decision, like selling a large position entirely, based on a single bad week of price action. That is not hypocrisy in any deliberate sense. It is the brain's short-term systems quietly overriding the long-term plan without the holder ever consciously choosing to abandon it. Bitcoin's specific market structure makes this mistake worse than it would be in a traditional long-term holding like an index fund. The market trades continuously, every day of the year, with no closing bell to create distance between the holder and the price. Constant availability means the short-term, emotionally reactive part of the brain gets far more opportunities to intervene in a decision that was originally meant to be evaluated on a multi-year timescale. This mistake compounds every other mistake on this list, which is why it sits last rather than first. A holder with genuine, structurally sound long-term conviction should be largely immune to herding, panic selling, the disposition effect, and anchoring, because none of those short-term triggers should carry much weight against a real multi-year thesis. The gap between the stated horizon and the actual decision-making process is where most of the damage from the first 4 mistakes on this list actually gets executed. You can see this pattern most clearly in the language holders use during a drawdown. A holder will describe themselves as a long-term believer in the asset, right up until the exact week they sell everything, often citing some new short-term concern as the reason, even when that concern has no real bearing on the original multi-year thesis. The words did not change, only the time horizon actually being used to make the decision changed quietly and without the holder noticing the shift in real time. There is a practical test for this mistake too, and it is uncomfortable precisely because it works. Write down, today, in a single sentence, what specific event would have to happen for you to actually sell your entire position, and compare that sentence honestly against what actually triggered your last real trading decision. For most holders, the 2 answers do not match, and the gap between them is temporal discounting, operating exactly as the research describes. Claiming a long-term horizon does not exempt anyone from real risk over a long horizon either, and temporal discounting is not the only failure mode worth worrying about. An asset can still underperform, stagnate, or fail to recover within any individual holder's actual investing lifetime, no matter how patient that holder claims to be or actually manages to be in practice. Conviction without a real written plan is not a strategy. It is a hope wearing a strategy's clothes, and hope has no mechanism for updating itself when the underlying facts change. The antidote to temporal discounting is not blind patience, regardless of new information. It is a plan specific enough that a holder can tell the difference between short-term noise and a genuine change to the long-term thesis. None of these 5 mistakes get solved by trying harder to feel less emotional in the moment, because the moment is exactly when the emotion wins. Willpower is not a reliable risk management tool, and every serious trader who has survived multiple cycles will tell you the same thing. The plan has to exist before the volatility does, not during it. The only thing that reliably beats all 5 mistakes on this list is a written framework built in a calm week when nothing is on the line. The first part of that framework is a specific written condition for adding exposure, defined using valuation and profitability data rather than a feeling about where the price might go next. That means having actual thresholds for metrics, like the profitability of the network as a whole, checked on a schedule instead of buying because a chart looks exciting or because everyone else is buying at the same time. A written entry condition removes the herding mistake almost entirely, because the decision was made before the crowd's mood had any chance to influence it. The second part is a specific written condition for reducing exposure, defined the same way, using data rather than emotional exhaustion. That single change directly addresses both panic selling and the disposition effect, because a holder with a predefined exit condition is reacting to a threshold that was set in advance, not to how unbearable the drawdown currently feels. It also removes anchoring from the equation entirely, since the exit condition never references the all-time high or the original purchase price in the first place. The third part is a fixed, boring review schedule, checked at the same interval every single time, regardless of what the price is doing that particular week. A 5-minute weekly review of the same handful of on-chain metrics covered in this video, treated like a recurring appointment rather than a reaction to fear, directly counters temporal discounting by forcing the long-term thesis back into view on a predictable rhythm instead of only during a crisis. There's a fourth part worth adding for anyone who has recognized more than one of these 5 mistakes in their own history: a short written record of the mistake itself, made immediately after it happens rather than months later. A single sentence describing what was actually felt in that moment, whether it was the pull of a rally, the panic of a drawdown, the relief of selling a winner, the anchor to an old high, or the quiet override of a long-term plan, builds a personal reference library far more useful than any general list of 5 mistakes could ever be on its own. None of this eliminates risk, and none of it promises a specific outcome for this cycle or any future one. What it does is remove the layer of self-inflicted damage that these 5 mistakes add on top of whatever risk the market itself was always going to present. That is the entire goal. Not predicting the market correctly every time, but making sure your own mind is not the reason you got the decision wrong. This is exactly why the Bitcoin Holder's Bible exists. It walks through all 5 historical drawdowns covered in this video in far more detail, the specific on-chain thresholds tied to herding, panic selling, the disposition effect, anchoring, and temporal discounting, and a worksheet that forces the entry and exit conditions from this framework to actually get written down before the next drawdown starts, not during it. The regular price is $97, and code Diamond50 brings it down to $47. And just like I told you at the start of this video, that comes with a full money-back guarantee. If you go through it and it doesn't give you a clearer system for holding, I refund you, no questions asked. Remember, this channel doesn't run on ad revenue anymore. Every person who picks this up isn't just buying a book, they're one of the people actually keeping this channel able to keep making videos like this one. I see the diamond, and the link is in the description and pinned in the comments below. Herding pulls a buyer in at the exact moment the crowd is most euphoric, executing a legitimate long-term thesis at the worst possible price, because the decision was never really about the thesis in the first place. Loss aversion pushes a holder out at the exact moment the pain becomes most acute, selling a position not because the facts changed, but because the discomfort crossed an unspoken threshold. Both mistakes are powered by the same underlying wiring, just triggered in opposite directions. The disposition effect locks in small wins and oversized losses at the same time, slowly reshaping an entire portfolio into its least efficient possible configuration without the holder ever making one single, obviously bad decision. Anchoring keeps a holder staring at a number, either the all-time high or the original purchase price, that stopped being relevant years ago, coloring every subsequent decision with a reference point the market has long since left behind. Both mistakes trapped capital in the past, instead of letting it respond to the present. Temporal discounting quietly turns a stated multi-year thesis into a series of short-term emotional trades, executed by a holder who genuinely believes, in the moment, that they are still playing the long game. It is the mistake that makes every other mistake on this list possible, because a truly long-term decision-making process should have been largely immune to all 4 of the others. Fixing this one mistake alone would prevent most of the damage caused by the previous 4. Notice also that every one of these 5 mistakes was documented in traditional financial markets first, decades before Bitcoin existed as an asset. and only later confirmed to apply just as strongly here. That should change how you think about the entire premise of this video. These are not crypto-specific character flaws, and they are not a reason to feel uniquely bad about how a single position was handled. They are simply what the unmodified human brain does with any volatile asset, and Bitcoin happens to be one of the most volatile assets available to test that against. None of this is a guarantee that Bitcoin recovers on any particular timeline, and nothing in this video should be read as a promise that patience alone fixes a bad entry or a broken thesis. The 5 mistakes explain why holders lose money relative to their own stated goals. They do not erase the real, structural risk that remains in this asset at any point in its cycle, including right now. Fixing the mindset does not fix the market, and it will never replace the need for an actual defensible thesis about why Bitcoin is worth holding in the first place. What fixing the mindset does is remove the self-inflicted damage layered on top of whatever risk the market itself was always going to present, which is a smaller promise than certainty, but it is the only one this video can honestly make. Bitcoin holders do not lose money because they picked the wrong asset. They lose money because 5 specific, well-documented mental mistakes take the wheel at exactly the moments when a written plan should have been driving instead. And every one of those 5 mistakes has existed in financial markets far longer than Bitcoin itself has existed. Fix the mindset, and the market can still hurt you. That risk was never going away, and this video was never going to pretend otherwise. What changes is that the market will no longer be doing the job your own emotions were doing for free. One hurting decision, one panic sell, one disposition trade, one anchored reference point, and one short-term reaction to a long-term thesis at a time. Drop a comment below telling me which of these 5 mistakes you have personally made and which one is currently the hardest for you to catch in real time. The most honest answers get pinned, because the point of this video was never to make anyone feel bad about a past decision. It was to make the next one easier to see clearly. If this video showed you your own pattern more clearly than your own timeline did, share it with the one holder you know who needs to hear mistake number 5 specifically. There are 2 kinds of holders left standing at the end of every cycle, and the difference between them was never intelligence or access to better information. One of them wrote the plan down in a calm week when nothing was on the line, and is simply running it today like any other Tuesday, checking the same handful of numbers on the same schedule regardless of whether the market is green or red. The other is building that plan for the first time this afternoon, under real pressure, with a red or green number flashing in front of them and adrenaline doing half the thinking for them. That version of the plan gets written in exactly the wrong conditions, shaped by whichever of the 5 mistakes on this list happens to be loudest in that particular moment. The choice of which one to be for the rest of this cycle is still open, and it does not require predicting the next move correctly. It only requires closing this video and writing the plan down before the next drawdown makes that decision for you instead. See you in the next one.